Every empire swears its money is safe. Every government vows its system is unshakable. But history tells a different story. No promise lasts forever. From the marble halls of Rome to the modern banks of Lebanon, the pattern is clear. When trust breaks, money vanishes. And yet, people keep believing their savings, their paychecks, their pensions are secure. They trust the system because it feels solid, because it's always been there. But what if that trust is the very thing putting you at risk? Today, we're diving into a story that's bigger than any one bank, any one crisis, or any one government. It's the story of why financial collapses aren't accidents. They're cycles, woven into the fabric of human systems. And more importantly, it's about what you can do to avoid being caught in the next one. This isn't just a history lesson, it's a wake-up call. Because the 2008 financial crisis didn't just shake markets. It reshaped global power, rewrote the rules of wealth, and left lessons most people still haven't learned. Let's start with a question. Do you trust your bank, your currency, the promises your government makes about stability? Most people do, until the cracks start showing. And by then, it's usually too late. Civilizations have fallen into this trap for centuries. They build systems, create wealth, and convince themselves it's eternal. But history is littered with the ruins of those illusions. Rome, Byzantium, even modern nations like Venezuela or Zimbabwe. They all thought their money was safe. They all learned the hard way. Take Rome. The denarius, their silver coin, was the backbone of an empire that spanned continents. It was as trusted as the dollar is today. Merchants accepted it from Britain to Egypt. Citizens saved it, spent it, built lives around it. But over time, emperors faced a problem. Wars, corruption, and overspending drained the treasury. So they did what empires always do. They cheated. They mixed cheaper metals into the denarius, diluting its value. A coin that once bought a month's supplies could barely buy a loaf of bread. People didn't notice at first. The coins looked the same, felt the same. But the trust underpinning them? That was eroding. By the time the empire collapsed, the denarius was worthless, and those who had hoarded it were left with nothing. Centuries later, the Byzantine Empire followed a similar path. Their gold coin, the solidus, was the gold standard of its day. It held its value for centuries, a symbol of stability in a chaotic world. But even Byzantium couldn't resist the temptation. As wars and debts mounted, they debased the solidus, mixing in less gold. The result? Inflation spiraled, trust evaporated, and the empire's economic power crumbled. Those who survived weren't the ones who clung to their coins, hoping for better days. They were the ones who saw the signs early, who questioned the system before it was too late. These aren't just old stories. They're warnings. Every financial system, no matter how strong it seems, rests on a fragile foundation. Trust. When that trust holds, money flows, markets thrive, and life feels stable. But when it breaks, everything unravels. And here's the thing. Trust doesn't just break because of wars or corruption. Sometimes it breaks because people stop believing, because they see the cracks, because they realize the system isn't as solid as they were told. The 2008 financial crisis was one of those moments. It wasn't just a market crash or a banking failure. It was a global wake-up call, a reminder that even the most powerful systems can falter. Banks that seemed untouchable, like Lehman Brothers, collapsed overnight. Homeowners who trusted their mortgages were left with worthless properties. Investors who believed in safe assets watched their wealth disappear. And governments, the ones promising stability, scrambled to pick up the pieces. But this isn't just about what happened. It's about why it happened, and what it means for you today. Because the forces that caused 2008 haven't gone away. They're still here, lurking in the global economy, waiting for the next trigger. And if history teaches us anything, it's that those who survive financial collapses aren't the ones who trust blindly. They're the ones who question, who prepare, who act before the storm hits. So where does that leave us? It brings us to the first big lesson, one that's hard to swallow, but impossible to ignore. Money isn't a foundation. It's a promise, and promises can be broken. Money only works as long as people believe in it. When that belief fades, when trust cracks, entire systems can collapse overnight. Rome learned it. Byzantium learned it. And in 2008, the world got a front-row seat to the same lesson. What does that mean for you? It means you can't just trust the system to protect you. You have to understand it, question it, and build your own defenses. Because the next crisis isn't a question of if. It's a question of when. And when it comes, the people who thrive won't be the ones holding on to empty promises. They'll be the ones who saw it coming. This sets the stage for what's next. The 2008 crisis wasn't just a random event. It was a turning point. One that shifted power, rewrote the rules of wealth, and changed the world in ways we're still grappling with. To understand how, we need to dig into what caused it, how it unfolded, and what it revealed about the systems we rely on. The year 2008 didn't just happen. It was a storm that had been brewing for decades, built on a foundation of greed, blind spots, and a dangerous belief that the good times would never end. To understand why the world shook, we need to go back and trace the roots of the crisis. Because what happened wasn't a fluke. It was the inevitable result of a system stretched to its breaking point, propped up by promises nobody could keep. Let's rewind to the decades before 2008. The global economy was booming. The United States, the world's financial powerhouse, was riding high on a wave of deregulation and innovation. Banks, freed from the tight rules of the past, were creating new ways to make money. One of their favorite inventions? Mortgage-backed securities. These were bundles of home loans sliced up and sold to investors worldwide. The pitch was simple. Housing prices always go up, so these investments are safe. Who wouldn't want a piece of the American dream? But there was a catch. To keep this machine running, banks needed more mortgages, so they loosened their standards. People who couldn't afford homes were suddenly approved for loans. Subprime mortgages, they called them. Risky, but packaged into complex financial products that seemed to erase the danger. Credit rating agencies slapped gold star ratings on these bundles, and investors, from pension funds to foreign governments, ate them up. Why? Because everyone believed the system was too big to fail. This wasn't just about bad loans. It was about a mindset. Wall Street had become a casino, and everyone was betting big. Banks leveraged themselves to the hilt, borrowing far more than they could ever repay. Hedge funds and investment firms created derivatives, bets on bets, tying the global economy into a web of risk. By 2007, the world's financial system was a house of cards, held together by one thing: confidence. As long as everyone believed housing prices would climb forever, the party could continue. Then the music stopped. In 2007, cracks appeared. Housing prices, which had soared for years, started to wobble. Subprime borrowers began defaulting on their loans. Those safe, mortgage-backed securities? They weren't so safe anymore. Banks holding these assets saw their value plummet. But the real problem wasn't just the losses, it was the panic. Nobody knew who was holding what, or how deep the damage went. Trust, that fragile glue holding the system together, started to crack. By September 2008, the dominoes were falling fast. Lehman Brothers, a 158-year-old bank, collapsed under the weight of its bad bets. It wasn't just a company going under. It was a signal to the world that no one was safe. Stock markets plummeted. Credit froze. Banks stopped lending to each other, and businesses couldn't get the cash they needed to operate. Ordinary people felt the shockwaves too. Homeowners faced foreclosure. Retirement accounts evaporated. Jobs disappeared. The crisis, born in the United States, spread like wildfire, hitting Europe, Asia, and beyond. What made 2008 so devastating wasn't just the money lost. It was the revelation that the system wasn't what it seemed. Governments had promised stability, but they couldn't stop the bleeding. Banks had promised security, but they were gambling with everyone's future. And the experts, the ones who said they had it all under control, they were just as clueless as everyone else. But the crisis didn't just destroy, it reshaped. Power shifted in ways that are still unfolding today. The United States, once the unchallenged leader of the global economy, showed its vulnerabilities. Emerging powers like China saw an opportunity. While Western banks were crumbling, China's state-controlled system weathered the storm. They didn't just survive. They started buying up assets, lending money, and flexing their influence. The crisis marked a turning point. a moment when the balance of global power began to tilt. For individuals, the lessons were just as stark. Those who trusted the system blindly paid the highest price. Homeowners who took on mortgages they couldn't afford lost everything. Investors who believed in safe assets watched their wealth vanish. But others, the ones who questioned the hype, who diversified their assets, who didn't bet it all on one system, came out stronger. They weren't lucky. They were prepared. This brings us to the second big lesson. Systems fail when they're built on illusions. The illusion of endless growth, the illusion of risk-free wealth, the illusion that someone, somewhere, has it all under control. 2008 tore those illusions apart. It showed that no bank, no government, no expert can protect you if you don't protect yourself first. And that's where the story gets personal. Because the forces that caused 2008 haven't disappeared. Easy money, risky bets, and blind trust are still part of the game. The question is, what can you do about it? How do you build a financial life that doesn't collapse when the next crisis hits? That's what we'll explore next, as we look at the aftermath of 2008 and the strategies that can shield you from the next storm. The 2008 financial crisis didn't just break banks or wipe out savings. It redrew the map of global power and forced the world to confront a new reality. The old rules, the ones that promised stability through trust in institutions, were gone. In their place came a new economic order, one shaped by hard lessons, shifting alliances, and a growing awareness that no one is coming to save you. But here's the good news. You don't have to be a victim of the next collapse. By understanding what changed after 2008 and taking steps to protect yourself, you can navigate the cycles that history guarantees will come again. Let's start with the aftermath. When the dust settled, the world looked different. The United States, still a giant, was wounded. Its financial system, once the gold standard, had shown its flaws. Trillions in bailouts propped up banks and markets, but the cost was steep. Public debt soared, and faith in institutions plummeted. People who once trusted banks to safeguard their money or governments to stabilize the economy started asking hard questions. If the system could fail so spectacularly, what else were they wrong about? Meanwhile, other players stepped into the spotlight. China, already rising before the crisis, seized the moment. While Western economies were reeling, China pumped money into infrastructure, bought distressed assets worldwide, and expanded its influence through loans and investments. The Belt and Road Initiative, a massive global trade network, gained momentum in the years that followed. By 2010, China had overtaken Japan as the world's second-largest economy, and its state-controlled system looked like a fortress compared to the West's crumbling markets. The crisis didn't just expose weaknesses, it accelerated a shift in power that's still reshaping geopolitics today. Europe, too, faced a reckoning. The crisis hit hard, especially in countries like Greece, Spain, and Ireland, where housing bubbles burst and banks teetered. The European Union scrambled to hold itself together, imposing austerity measures that sparked protests and deepened distrust. The euro, once a symbol of unity, became a battleground for debates about sovereignty and economic control. Some nations recovered faster, like Germany, but the scars of 2008 fueled populist movements and fractured the dream of a united Europe. For individuals, the impact was personal. Millions lost homes, jobs, and retirement savings. Those who had trusted the system, believing their mortgages were safe, their investments secure, or their pensions guaranteed, faced the harshest realities. But the crisis also birthed a new mindset. People started looking beyond banks and governments for security. They turned to alternative assets, like gold, real estate, or even cryptocurrencies, which began gaining traction in the years after 2008. The idea of self-reliance, of not depending on a single system, took root. This brings us to the third big lesson. Resilience comes from control, not trust. The people who came through 2008 stronger weren't the ones who waited for bailouts or believed the system would fix itself. They were the ones who took charge of their own financial lives. They diversified their investments, learned to spot risks, and built buffers against uncertainty. And that's the key for you today. Because the forces that caused 2008, over-leveraging, blind trust, and interconnected risks, haven't gone away. They're still here, hiding in new forms, waiting for the next spark. So, how do you protect yourself? First, question everything. Don't assume your bank, your currency, or your government is bulletproof. History shows they're not. Look at your savings and ask, what happens if this system falters? Diversify across assets and regions. Gold, real estate, or even stable foreign currencies can act as hedges against local crises. Cryptocurrencies, while volatile, offer a way to bypass centralized control, though they come with their own risks. The point isn't to pick one silver bullet. It's to spread your bets, so no single failure can wipe you out. Second, understand debt. The 2008 crisis was fueled by borrowing run amok, from subprime mortgages to leveraged banks. Personal debt can be just as dangerous. If you're carrying loans you can't pay off quickly, you're vulnerable. Prioritize paying down high-interest debt and avoid tying your future to promises you can't control, like adjustable-rate mortgages or speculative investments. Third, educate yourself. The people who thrived after 2008 weren't financial geniuses. They were curious. They read, asked questions, and learned how the system works. Start small. Understand inflation, interest rates, and how your country's economy connects to the global one. Knowledge isn't just power, it's protection. Finally, think long-term. Crises are cycles, not one-off events. The next one might not look like 2008, but it will come. Maybe it's triggered by a new asset bubble, a geopolitical shock, or a currency collapse. Whatever the cause, the principles stay the same. Build a financial life that can weather storms. Keep cash reserves for emergencies. Invest in skills that hold value no matter the economy. And always question the promises you're sold. The 2008 crisis wasn't just a moment in history. It was a warning, a reminder that no system is eternal. It showed us that power shifts, wealth vanishes, and trust can betray you. But it also showed that those who see the patterns, who act before the collapse, can come out stronger. You have that choice today. The new economic order is still taking shape, and your place in it depends on the steps you take now. The 2008 crisis showed us that no system is unbreakable. Don't wait for the next one. Take control now. Diversify your assets, reduce debt, and learn how money really works. Subscribe to join others building resilience for the future. Comment below. What's your first step to protect your wealth?